PantheonAI presents PAI Morning Briefing, April 28th. Welcome to the PAI Morning Briefing.
Good morning, everyone. So glad to have you with us today.
Absolutely. It's April 28th, 2025, and we're diving into all the latest market updates, breaking news, and really a robust analysis of what's shaping the financial landscape right now.
Yeah, it's a busy morning. We've got a packed agenda. We'll start with a quick look at the overall market performance, then jump into some major headlines, dig into sector highlights, and finally, wrap up with our expert insights and predictions.
Sounds like a plan. So let's kick things off with the pulse of the market, shall we? The S&P 500 is trading at approximately 5,536.16. We're seeing a slight uptick there, around 0.125%.
Okay, nice little start there. How about the Dow?
The Dow Jones is also reflecting some positive sentiment. It's currently sitting at roughly 40,271.37, up by about 0.25%.
Even better. And Nasdaq?
Over on the Nasdaq, trading near 17,402.02, the gain was a bit more modest, roughly 0.06%.
Interesting. So tech's a little slower out of the gate today. What about the smaller caps?
In the smaller cap space, the Russell 2000 is at approximately 1,967.48, making a gain near 0.36%. So a little stronger there.
Okay, so equities are showing incremental gains across the board. What about digital currencies?
Good question. Shifting away from equities, digital currencies are definitely in the mix. Bitcoin recently reached around 94,435.93, up by roughly 0.7%.
Wow. Breaking 94,000 again. And Ethereum?
Ethereum is trading near 1,792.76 with a very subtle increase, about 0.04%.
Got it. So interesting to see these incremental gains across so many segments today. It really does suggest that cautious optimism is prevailing among investors, wouldn't you say?
I think you're right. Taking a deeper dive into some of these trends, one thing that continues to impress is the resilience we're seeing, despite the mix of global uncertainties and domestic challenges.
Yeah, when you look at those key indexes, the modest percentage gains, they instill confidence without getting into that overly exuberant territory, which can be a good thing.
Exactly. The uptick in the Dow and S&P 500, for instance, indicates investors are still comfortable with blue-chip stocks right now. But, as you pointed out, the Nasdaq's slower movement, that might suggest tech companies, which have historically driven innovation, are perhaps pausing a bit amid regulatory developments and that increased volatility in tech spending.
That makes sense. And what's particularly notable to me is the behavior of the cryptocurrency markets. Bitcoin and Ethereum showing those modest gains today. It reinforces this narrative that digital assets are maturing into a more stable asset class, even though investors are still cautious.
It's a slow, steady recovery, isn't it? It definitely contrasts with those dramatic price swings we saw not too long ago. Could it be that market participants are starting to view cryptocurrencies as more than just speculative instruments?
Perhaps. Institutional interest seems to be driving some gradual stabilization there. But okay, let's shift gears a bit. We've got some compelling stories making waves today. 10 key headlines to discuss.
All right, let's jump in. First up, Sabre. Their shares surged after announcing a $1.1 billion deal to sell their hospitality solutions business to TPG.
Wow, $1.1 billion. That's not just a routine divestiture, is it? That signals a pretty pivotal strategic shift for Sabre.
Definitely. By offloading that major segment, they're not only streamlining operations, but really positioning themselves to focus on core competencies in travel technology. You know, sometimes less really is more when you're trying to stay competitive.
Good point. Okay, next headline, Domino's. Their profit performance actually fell short of analysts' estimates. U.S. sales dropped and margins shrank.
Oh, that's tough. Even with a boost from their international business, that decline in domestic performance really left the stock faltering in pre-market trading.
It's a solid reminder that even widely recognized brands have to stay nimble and adapt quickly to changing consumer trends. It's like a case study in how market leaders really need to continually reinvent themselves or risk being left behind.
Totally agree. All right, headline number 3, Palo Alto Networks. The cybersecurity titan has announced a deal to acquire PantheonAI.
Cybersecurity is just so crucial right now. This acquisition, It seems like a strategic move to broaden their portfolio and enhance their capabilities against increasingly sophisticated threats.
Absolutely. It's a clear example of how companies in tech and security are investing heavily to stay ahead of potential cyber risks.
Moving on, another major deal. Alkane Resources is set to acquire Canada's Mandalay Resources. This one's valued at roughly $358 million.
Okay, so big development in the resources sector. It underscores that ongoing consolidation trend we see in mining and exploration.
Right. These kinds of M&A deals are often about achieving synergies, reducing costs, and bolstering competitive position globally.
Definitely. Next, Marriott. They've decided to acquire the citizenM brand.
Marriott acquiring citizenM? That's interesting. As the hospitality landscape evolves, a traditional operator picking up a trendy, uniquely positioned brand like citizenM. It highlights that trend of looking to capture the millennial and Gen Z markets, who are really looking for those boutique, agile experiences.
It's a fascinating blend of legacy and modernity, for sure. Okay, Medicus Pharma is next. They've announced they'll acquire Antev in a share exchange transaction valued at approximately $75 million.
$75 million. This one's intriguing, especially given its potential to reshape dynamics in the pharmaceutical and biotech arena. Strategic acquisitions like this are often aimed at complementing existing pipelines and driving future growth.
Exactly. We'll be watching closely to see how that unfolds in the competitive healthcare space. Shifting gears now to the agriculture sector in the United States.
Yes. Amid swirling concerns about trade war tariffs, some U.S. agriculture exporters are warning that we're already in the midst of what they're calling a full-blown crisis.
A full-blown crisis? That sounds serious. Cancellations of orders and widespread farm layoffs. It's left many in the industry anxious. It's a stark reminder of how interconnected global politics and trade policies are with the day-to-day realities of farming communities.
It really is. The big question here is, are policymakers keeping pace with ground-level challenges? Or is there more that needs to be done to protect this vital sector?
Good point. Next, a story from across the Atlantic. A massive power outage strikes parts of Spain and Portugal.
Wow, a massive outage. The exact cause is still unclear even after a couple of hours, but it's raised concerns over energy infrastructure stability in the region.
Definitely. In a world increasingly dependent on consistent energy supply, an outage of that scale, it can really ripple across multiple sectors, from industries to essential services. It prompts urgent questions about resilience and preparedness in our utility systems.
Absolutely critical. Okay, let's talk foreign exchange. The USD-CAD pair.
Right. The currency pair is currently trading within a narrow range, about 43 pips. That's well below the 113 pip average we've seen over the past month.
43 pips. That is tight. What's the movement been like today?
The session low was set early, around 1.3849, while the high reached nearly 1.38917. The current price is trading around 1.3868.
Okay, so traders looking at technical charts, what are they seeing?
They've noted the pace is unfolding around the 100 and 200-hour moving average downside target, yet buyers seem to be reinvigorating the pair on the first look. It's a nuanced situation that highlights both the challenges and opportunities in the Forex market right now.
Definitely something to watch. And our final headline for today, Upwind has acquired Nix Security.
Yeah, this is a bold move in the tech and cybersecurity arena. It's really to solidify their position in the application runtime security space.
It's seen not just as a blend of technology, but almost a strategic war for dominance in cloud security solutions, isn't it? It's a compelling narrative of how emerging companies are being absorbed by larger players trying to expand their foothold in critical, high-growth areas like cybersecurity.
That's a great way to put it. So having covered the headlines, let's take a moment for a detailed sector analysis.
Sounds good. Let's start with technology, since we just touched on it with those acquisitions.
Okay. In the technology sector, there is a clear trend toward consolidation and strategic acquisitions. It's really driven by the need to safeguard and expand market share in a competitive landscape.
Right. Companies like Palo Alto Networks and Upwind are making significant moves. It reinforces that notion that cybersecurity and cloud security are really front and center for investors.
Exactly. With digital transformation still critical for businesses, tech companies are under constant pressure to innovate while defending against evolving threats. As this sector matures, investors should be alert to both the opportunities from M&A and potential laggards who might struggle to adapt.
Good point. Turning our focus to the energy sector, that recent power outage in Spain and Portugal, it's raised broader concerns about energy resilience, especially in a period marked by rapid tech and policy shifts.
Absolutely. As economies shift toward renewables, ensuring consistent supply and robust infrastructure is paramount. While outages might reignite debates over policy and grid reliability, they also present opportunities for companies specializing in energy storage and smart grid solutions.
Definitely. Investors might want to monitor developments in those areas, as they're likely to see increased activity and potential growth.
On the financial front, we continue to observe caution in traditional sectors, even with those modest index gains we saw earlier. The slight improvement suggests cautious optimism, but the Nasdaq's slower pace highlights a potential divergence between tech heavyweights and other sectors.
Right, and that Forex market, the USD-CAD pair, it offers an intriguing case study in technical nuances. Traders who stay agile could find opportunities there despite the contained range.
For sure. And the international banking space is closely watching developments in trade policies, especially after that upheaval in U.S. agriculture. The intersection of tariffs, regulations, and global trade. It can really reshape financial flows on a macro scale.
It's all so interconnected, isn't it? Expanding our horizon globally, it's important to note that while the U.S. and European markets are absorbing these stories, Asia and emerging markets are feeling the ripple effects too.
Exactly. The trends we see today, from tech consolidation to commodity volatility, they're tied to broader currents of global capitalism. We have to ask ourselves, in an environment where every headline seems interwoven with geopolitical shifts, what's the true measure of market stability?
Is it just the percentages ticking up in large indexes? Or something more robust, like adaptive strategies in sectors vulnerable to both physical and digital disruptions? These are the kinds of questions that investors and policymakers really need to be stirring over their morning coffee.
Couldn't agree more. Okay, shifting now to some expert insights and predictions. I think we have a couple of interesting themes emerging from all of this.
All right, what are you seeing?
First, those strategic divestitures and acquisitions, like Sabre and Upwind, they signal that companies are increasingly recalibrating their portfolios to focus on high-growth sectors and technologies.
So we might witness a series of similar deals over the next several months as firms try to carve out competitive advantages?
That's my read. Of course, with any acquisition, there's due diligence needed, not just by regulators, but by investors who need to evaluate if these moves will translate into sustainable growth.
Right. And second, that slightly sluggish performance in tech indices, juxtaposed with modest gains in traditional sectors, it points to an ongoing recalibration within the market itself.
Yeah, investors are starting to differentiate between companies that can rapidly innovate and those that might be more vulnerable to external pressures, like increased regulation or economic headwinds. It brings us back to our earlier point on tech. While potential for rapid returns is vibrant, caution is warranted due to growing regulatory scrutiny and the inherent volatility.
Definitely. Third point?
In the energy sector, that massive power outage in parts of Europe, it acts as a clarion call for infrastructure investment. It signals that even in developed markets, there's a pressing need to upgrade systems to withstand unexpected challenges.
Absolutely. This is an area where government policy, public-private partnerships, and technological innovation really need to converge in a concerted effort.
Couldn't agree more. Another angle to consider is the impact of all these developments on retail investors. With headlines that are both encouraging and cautionary, how does the everyday investor navigate this sea of information?
That's a great question. One thought-provoking approach is to view each story as a signal about broader market trends. Whether it's tech consolidation or energy grid vulnerability, these aren't isolated events. They're parts of a larger narrative about how modern economies are adapting.
Right. Investors might ask themselves, are my holdings diversified enough to weather these shifts? Or am I overly concentrated in sectors that might be particularly sensitive to these emerging dynamics?
Good points for reflection. And sometimes the market behaves a bit like your overly caffeinated uncle at family gatherings. Energetic, unpredictable, and occasionally hilariously off track.
Haha, that's a good analogy. Yet, just like that uncle, the market always brings something interesting to the table. And while it might make you scratch your head at times, There's always a lesson hidden in its behavior.
So true. Let's circle back for our detailed look at individual sectors post-news, just to reiterate some key points. Starting again with technology.
Okay. The tech space is clearly on the move. With Palo Alto Networks and Upwind taking bold steps, investors are reminded that the pace of change is rapid. Tech companies aren't just creating new products. They're actively reconfiguring their business models through acquisitions and strategic partnerships.
Yeah, these recent moves hint at an industry where being agile and adaptable is absolutely essential. It might be a good idea for tech enthusiasts and investors to look beyond just the quarter-to-quarter earnings and focus instead on how these strategic developments position companies for the longer term.
That's smart thinking. In technology, a short-term hiccup today can sometimes lay the groundwork for robust expansion and innovation tomorrow.
Absolutely. In the energy sector, that unexpected power outage in Spain and Portugal, it's really reignited debates about reliability and, frankly, fraud prevention in our utilities.
Right. Such events highlight the importance of investing in resilient infrastructure. Energy companies that move quickly to adopt smart grid solutions or develop robust contingency plans, they might not only reinforce confidence among stakeholders, but could also capture a significant market advantage.
Definitely. It's an area ripe with both risk and opportunity, where being proactive can really pay off.
Finance, as a sector, continues to demonstrate both steady performance and underlying challenges. That modest growth in major indexes shouldn't lull investors into complacency.
No, not at all. With global trade tensions affecting sectors like agriculture and ripple effects in smaller cap markets like the Russell 2000, financial institutions have to navigate an increasingly complex web of risks.
For banks and financial service firms, diversification and risk management are more than just buzzwords. They're essential operational strategies. A prudent investor will keep a close eye on evolving policy risks and global economic indicators, ensuring their portfolios align with a broader, more nuanced understanding of the market.
Absolutely. And when we look at the broader global market implications, a recurring theme is interdependence. Whether it's the impact of U.S. tariffs on agriculture or the knock-on effects of power outages in Europe, nothing in today's financial ecosystem exists in isolation.
That's so true. Global supply chains, cross-border transactions, multinational corporate strategies, they all hinge on the interplay of various factors, from local policies to global economic cycles. Investors should be mindful of these interdependencies and consider how policy shifts in one region can have a cascading impact globally.
It's a dynamic reminder that the world we live in really is a small one, where every local tremor can be felt far and wide.
Well said. As we wrap up today's discussion, let's just revisit a few key takeaways.
Okay, what stood out to you?
First, today's market performance showed modest gains across all major indices, signaling that cautious but optimistic investor sentiment. Whether it was the S&P 500, the Dow Jones, or even the Nasdaq, it appears market participants are holding a steady course.
Right. Second, that series of recent headlines, from Sabre's divestiture and Domino's struggles to Palo Alto Networks acquisition, it underscores that strategic repositioning is really at the heart of today's business landscape. Companies are constantly reassessing their portfolios to adapt.
Definitely. Third, sector-specific issues, like the energy outage in Europe and the technical nuances in the USD-CAD pair, highlight that market opportunities often come hand in hand with hidden risks.
And finally, as technology and digital assets mature, it remains essential for investors to periodically recalibrate their strategies and look at that broader picture.
Absolutely. Before we close, I'd like to leave you with a couple of thought-provoking questions.
Lay them on us.
How do you see the trend of strategic acquisitions reshaping the competitive landscape in your sector of choice? And what are your thoughts on the balance between technology innovation and regulatory oversight, and how might these dynamics influence your investment strategies in the near term?
Those are big questions. And perhaps most intriguingly, as industries adapt to both digital and physical vulnerabilities, which companies do you believe are best positioned to leverage these changes for long-term gains?
Yeah, it really makes you think, doesn't it? I encourage you to ponder these questions as you review your portfolios and consider the evolving market narratives.
And remember, if you ever need a sounding board or have questions about these developments, our very own AI copilot at PantheonAI is always here to help.
Excellent point. Thank you for joining us today on the PAI Morning Briefing. It's been an engaging session exploring the nuances of market movements, headline stories, sector trends, and the broader implications for global investors.
We hope you found this analysis insightful and that it helps sharpen your investment strategies as you navigate the complexities of today's financial environment.
Be sure to tune in for the next episode tomorrow for more deep dives, expert insights, and opportunities to engage with our AI copilot. Remember, learning shouldn't feel like a full-time job.
Absolutely. Until next time, stay informed, stay curious, and keep challenging the conventional wisdom.
Have a fantastic day ahead.
You too. PantheonAI, your information copilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.